Ladies and gentlemen, good day and welcome to V-Guard Industries Limited Q1 FY26 earnings conference call hosted by Nirmal Bang Equities Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Arshia Khosla from Nirmal Bang Institutional Equities. Thank you and over to you, ma'am.
Thank you, Palak. I, Arshia Khosla, on behalf of Nirmal Bang Institutional Equities, welcome all of you for the first quarter FY26 earning call for V-Guard Industries Limited. From the management today, we have Mr. Mithun K. Chittalapalli, Managing Director, Mr. Ramachandran V., Director and Chief Operating Officer, and Mr. Sudarshan Kasturi, Senior VP and Chief Financial Officer. I would now request the management to give their opening remarks, post which we shall open the floor for Q&A. Thank you and over to you, sir.
Thank you, Arshia, and the team at Nirmal Bang for hosting today's call. A very warm welcome to everyone joining us to discuss our company's operating and financial performance for the first quarter of FY25-26. I trust that all of you have had the opportunity to review the investor presentation we had shared earlier. Top-line growth for the first quarter FY26 was subdued due to weak summer season and the high base of last year. Consolidated net revenues from operations for the quarter is 1,466 crore, a marginal decline of 0.7% over the revenue recorded in the corresponding period of the previous financial year. The electronic segment, comprising of stabilizers, inverter systems, UPS systems, and solar systems, delivered moderate revenue growth at 4.5% YOY in the first quarter. Demand for stabilizers was subdued in line with the overall demand trends for cooling products, but this was offset by good growth for products in the other products within the segment. The electrical segment, which remains our largest revenue contributor, that includes wires, pumps, switchgears, and modular switches, registered a YOY growth of 7.6%. Hence, the performance was steady both from a top line and margin perspective. In the consumer durable segment, covering fans, water heaters, kitchen appliances, and air coolers, we reported a revenue degrowth of 16.3% YOY. Growth was impacted by early onset of monsoon, which curtailed the summer season and caused a sharp drop in demand for cooling products. Sunflame reported top-line degrowth of negative 5.4% on a YOY basis in Q1. There has been some improvement in light of interventions undertaken earlier, and the business has done well in general trade, but continues to face softness in the CSD channel. We have also initiated actions to merge Sunflame operations with V-Guard, which will fast-track realization of this synergy benefits. Since the merger is with the wholly owned subsidiary, there will not be any share exchange ratio or change in the shareholding patterns of the company. In Q1 FY26, revenue from non-South markets grew by 2.1% YOY, now contributing 52.3% of the total revenues, while South markets degrew by negative 3.3% YOY. Our strong markets, that is the southern and eastern regions, were relatively more impacted by the weak summer. We reported a gross margin of 36.7% this quarter compared to 36.6% in Q1 last year on a sequential basis. The gross margin improvement by around 110 basis points from 35.5% in Q4 FY25. As we had indicated last quarter, margin recovery is nearly complete and we are back to the pre-COVID margin levels. EBITDA, excluding other income for Q1, stood at 124 crores, declining 20.7% on a YOY basis. The EBITDA margin was 8.4%, a reduction of 210 basis points from 10.5% recorded in Q1 FY25. Consolidated profit after tax for the quarter was 74 crores compared to 99 crore in the same period last year. The decline is due to the operating deleverage on account of flattish revenues. We expect the demand to normalize in the coming quarters and continue to invest in brand building and capacity enhancement. With that, I conclude my opening comments. I would like to thank Arshia and the team at Nirmal Bang for hosting this call and would like to request the moderator to open the floor for Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rahul Agarwal from EGI Asset. Please go ahead.
Hi, good afternoon. This is Rahul from Ikigai Asset. Within 3 questions. Firstly, your entry into lighting, just to understand what are you thinking about it, what are the products, which segment are we talking about? Second question was on ECD. I understand fans and coolers would have seen a very large impact. But when I look at the company history, first quarter has never saw a bit loss, right? Except if I remove the COVID period 21-22. So is it more of a function of, I understand operating DLF, but because of newer plants, is there more OPEX sitting there, which is why this is impacted, or the ad expenses which have been a bit higher YOY, is that impacted for a specific campaign? And thirdly, some comments on inverter sales and wires, that would help. That's all from my side.
Yeah. So I'll start with the lighting. So as you know that we are having a portfolio of categories in the electrical space, and lighting is the largest subsegment within the electrical space. I mean, lighting and wires are the 2 large categories, and we were present in wires and fans, which are the 2 other large segments, but lighting was absent. And we have been getting a lot of feedback from the channel that there is a huge white space and we are not present, and this is creating some gap in the product portfolio. So this is point number 1. Point number 2 is we are already having a very, very good network of electrical retailers across the country. A good part of the 100,000 retailers we have is from the electrical segment, and lighting has almost 95% overlap with the wire retailers. So this is the second point, that we have the channel. So I think it's also now we believe that we are having enough bandwidth to start creating a new category, and this is the thought behind it. Ram, you want to add anything about this lighting part?
No, I think as you already said, I think it's mainly we've been under a bit of pressure from our trade partners to expand our portfolio and to include lighting, because this completes the bouquet of offerings on the electrical side. Yeah, and that has been the primary driver for that, and it is to complete our basket of offerings. Yeah? And there is a lot of synergy both on channel side and even on the GTM side. So the effort required for us to get into lighting is very, very minimal, and therefore we decided to go ahead.
Yeah. On the ECD side, see, the ECD has got fans and air coolers. Within fans, there is a segment called TPW. TPW business has significantly been lower, and so has been air coolers. So I think both these have pulled out good percentage. As far as loss is concerned, we don't think it's a huge issue. It is a transient issue, and yes, there would be some advertisement expenditure that was booked in both fans and air coolers. So it is very much possible that is also one of the reasons that we are hitting a loss. But I think this time we had extremely cool summer. So last year we had a very, very unnaturally hot summer, which propelled the demand for a lot of categories, especially cooling products. This year we had the reverse, where we hardly had any kind of summer, especially in southern part of the country and eastern part. So these two being our core markets, we faced that headwind. Wires has done well. Wires has done well because there is a favorable raw material price situation, where in which there was some step-by-step increases of copper prices over the quarter, which meant that demand situation was good. We were also having inventory to supply. So wire, in fact, has, done well. Switchgear also has done well. They have also grown well. That's not because of any price increase. Switchgear, I think we have made some corrections in the team and channel and all that, and that's beginning to deliver, fruits. So that's as far as the question is concerned. Thank you.
Just to follow up, so on lighting, what kind of products are we talking about, and is it we're also going to get into manufacturing of this?
No, initially we are not looking at manufacturing. I think with V-Guard, most of our categories we have entered and seeded by, the outsourcing model. Initially we will not be a manufacturer, but I think once we get to a certain scale, definitely we will look at manufacturing and bringing in efficiency. We are looking at the consumer part of the lighting and the residential part of the lighting. So this is the initial focus. Anything that is going into consumer and residential lighting is what we will look at.
Got it. And a follow-up on ECD, then maybe I'll get back in the queue. Was the primary sale for fourth quarter very high, and hence channel inventory was high, and hence our performance on fans, coolers was a bit subdued versus peers? Because when I benchmark other listed companies, it looks like our degrowth is much higher. Any thoughts on this?
Yeah. So I think it's more than pre-selling. It's more of a geographical issue. So South India has a much higher share of TPW sales in summer than other parts of the country, and V-Guard is one of the largest seller of TPW fans in South India. So for us, it's got to do more with rather than selling it in March. Most of the degrowth has come from the TPW segment. In fact, the ceiling fan sales have not degrown much. The second is air cooler. Air cooler also, there is beyond a point we are not able to sell the product because we sell on advance. So we sell with the similar kind of terms as the market leader, which is an advance payment. So even in air coolers, there is no question of channel being stuffed too much because the trade partners have to pay advance. So yeah, I hope it's clear.
Perfect. Yeah, this really helps. Thank you so much for answering, and all the best for the rest of the year.
Thank you, sir. The next question is from the line of Aniruddha Joshi from ICICI Securities. Please go ahead.
Yeah, thanks for the opportunity. Two questions. So now we are merging the acquired entity with ourselves. So what are the synergy benefits by merging the kitchen appliances business? I guess most of the operational synergy benefits are already there, but still there will be some benefits in terms of a reduction in the number of invoices or double billing to the trade, etc. So what are the total synergy benefits that we can look at? That is question number one. And question number two, in case of lighting, now obviously this segment, we have seen the technology changes are so rampant that even most of the larger players are also finding it difficult to in a way generate value. So what will be V-Guard's right to win in this segment? Means obviously we have the brand as well as the distribution network also. But what will be the focus area? Means whether it will be B2C more, B2B more, and even the distribution network for many players is also separate from the ECD or rest of the distribution networks. So how are we thinking on these lines? Yeah, these are the two questions. Thank you.
Okay. Ram, you want to take this?
Yeah. I think, fundamentally, it's, we're going to be leveraging the brand and the channel, yeah, and our channel relationship, yeah. I think that's going to be our fundamental focus. I think initially our strong focus is going to be in our core markets, which is South primarily, yeah, to start with, yeah, which is where, we will focus heavily. We are pretty confident that we can get some good and quick early wins in that area. The Yes, I think, there are challenges. There are different challenges with different categories. Yeah, I think the challenges with lighting are different in nature from other categories. But I think, as an organization over a period of time, we have significantly matured and, both our sourcing capability and development capability. And, we have very strong electronics capability in the company also. And, so we are pretty confident that, we can navigate this. Of course, there will be a learning period as with any business. And, and there will be a learning curve that we will observe in our case also. Yeah. So, I think that is on lighting and, the question on Sunflame. So I think, more than synergy benefits, right? So it is a question of bringing V-Guard's capability into Sunflame for driving growth in Sunflame. Initially, see, Sunflame is a small entity which was, managed, by the promoter. It was thinly staffed. It was, run in a very, very agile manner. And we had challenges to, quickly move in our capabilities before understanding the business. I think that we've taken 18-24 months to understand the business, and we are now moving fast with a quick integration. To give you an idea, I mean, synergy benefits, financial benefits apart, I mean, that's not the focus of why we are doing this. I think I'll give you some sense of, for example, we have, in about 60, I think in about 70 days, right? We have integrated the customer service nationally, and what I would say call resolution, right? Rates, 24-hour call resolution rates have gone up to almost 60%. Yeah, and this will progressively, get better. So that's one example. Yeah, and so we just want to bring the functional strength of V-Guard into Sunflame, which we believe will significantly empower Sunflame growth. That, of course, includes also our channel partners, right, and our business system, right? We have a very strong nationwide sales infrastructure and a very aggressive sales infrastructure, which is extremely capable to scale up businesses in shorter period of time. Yeah. So I think, thus far, we had been, keeping Sunflame away from, V-Guard's capabilities, and this is what will happen to Sunflame. Our capabilities will flow in faster. Primarily, our focus is going to be on R&D and NPD and the go-to-market. Yeah? So we believe, we should be able to significantly strengthen Sunflame going forward. Yeah?
Okay, sure, sir. This is very helpful. Thanks for the explanation. Just one last thing. Will Sunflame be rebranded under V-Guard umbrella? Means like Sunflame by V-Guard or V-Guard?
No, I think as we had said the last time in the previous call, right? So we have a Sunflame. We have a project for the long-term strategy for Sunflame. Yeah. I think once we conclude that, I mean, we maybe we'll have a point of view in maybe a couple of months on that, right? So we'll come back. I think we haven't made a determination in terms of how we will treat. Yeah, but of course, I mean, the moment there is integration of Sunflame and V-Guard, yeah, V-Guard name will be carried by every Sunflame pack as the manufacturer. But that apart, how to position Sunflame, whether as a sub brand or as an independent brand, I think there is work happening in that area. We are doing some work with consumers, and we are also internally doing some work to understand what is the best way to go forward. Yeah. We have some proposals and point of views. We have not formed it up yet.
Okay, sure, sir. Just one bookkeeping question. Lighting, are you looking at any revenue targets, let's say over next 2 years or 3 years?
No, we wouldn't like to give out any projections as of now. Yeah, we will update in the next call.
Okay, sure.
I don't think we'll be giving out projections anyway, but our first, 6 months to 12 months will be setting up capability and systems, and then only we will look at, launching. Yeah.
Okay, sure, sir. This is helpful. Many thanks.
Thank you, sir. The next question is from the line of Keyur Pandya from ICICI Prudential Life Insurance. Please go ahead.
Sir, first on the lighting side, so you talked about the synergies of, say, cross-selling, GTM, distribution, etc. In general, we have seen that because of the price deflation, very few brands have been able to grow their lighting sales in terms of value, and also a lot of competition from the smaller brands, value conscious brands. So any specific reason, from that perspective, why you would want to enter the segment where growth is not there, either because of the technology change or price cuts, but the value growth has not been there? That is first point. Second question, on the overall margin side, I can see, say employee costs have grown at a faster pace, and you earlier explained that as you grow in-house manufacturing, some of the overheads move in-house. So if I look at slightly longer term data, your EBIT margins, EBIT margins are more or less similar. So your gross margin has gone up, but depreciation, employee costs and overheads have also gone up. And EBIT margin are more or less in the range of 7.5%. So just to understand, are we yet to see any benefits of in-house manufacturing, or why they are not yet visible, since at EBIT level margins are more or less similar levels? These two are the questions, and then we'll get back in the queue.
Yeah. So regarding the second part, which is EBIT margins, I've said this in an earlier call. So if you look at 2019, our larger, two competitors, they used to have EBITDA of about 14%. Today, both of them are at 10%. Whereas we are still, having the similar EBITDA of about 9 to 10%. So you can see that the competitive intensity in the sector has gone up, and margins have come down for most companies. Whereas we have maintained margins if you look at last 6 years. So that's, I hope that, answers your second point. The first point is on lighting. Ram, you want to take this? Yes.
Yeah. I think, yes, I think, you're right. I think lighting as a sector has not seen value growth. Yeah. And fundamentally because of price erosion. And that part is true. But I think that, every business has a different dynamic and a different challenge. Yeah. So I think, and that needs to be managed independently and separately and appropriately. Fundamentally, yes, not having lighting and having lighting has its own advantages and disadvantages for us, as part of playing the portfolio. Yeah? But I think it's important, because see, we have partners. Okay, we have partners, and our partners have businesses, right? And we have gap in our portfolio, right? And we believe that incrementally for us, right, at least for the next 7-8 years, yeah, I think this is not going to be a challenge. And although it can be a challenge for an incumbent player who's been in the industry for many years, right? The other part of it is also that, even though there is not value growth, but I think that, the businesses are profitable, and, they are able to do that by managing different cost elements differently. Yeah? So I think, at least for the next 7-8 years, I don't see, this question being a challenge for us, while it may be a challenge for the industry. Yeah? But I think what it will do, it will strengthen our, partner capability. Yeah? And it will help us to, what I would say, expand our network faster, and it will also help existing categories to travel more deeper and wider. I think in the past, we had multiple challenges, but we believe many of our challenges for some of the categories that we had incubated in the past are slowly and progressively getting out of the way, and we now have room to nurture and support one more category.
Understood, sir. So just one small question on the electronic side. So relatively weaker quarter, and despite that, you have maintained and margins upwards of 19%. So barring for seasonality versus Q1, Q2, Q3, which are relatively smaller, should we assume that, annualized margin of higher than 18%-19% are sustainable margins? You earlier talked about some strategic initiatives as well. So in that backdrop, what are the sustainable margins in electronics?
Yeah. Sudarshan, you want to take this?
Yeah. Okay. On electronics, yes, I mean, the stabilizers did see a decline in line with air conditioner sale or cooling product sale. But then that was made up by a strong performance in other products. You know, the inverter battery business did well, solar did well, so that sort of made up. Margins-wise, it's been good, but I don't think we should take 18-19% as a steady state margin. So there are some quarters where we get better margins than usual. Something like 17 should be okay. Should be sustainable.
No, sir, on an annual basis.
Yeah. So that's how it is. 19 is a bit. It's a good number for that category. That may not remain at that level all the time.
Okay, noted. Sir, thanks a lot and all the best. Thank you.
Thank you, sir. The next question is from the line of Raman from Sequent Investments. Please go ahead.
Hello, sir. Am I audible?
Yes, sir.
Yes.
So, I just wanted to understand that Q1 there has been a degrowth in Q1, which you already suggested in your previous call. Can we, the original guidance of 14 to 15% revenue growth, is it still doable? And with respect to the margin, can we expect margin to improve going forward?
So I think how we look at it is, when we have a good year, like last year we grew by about 17%. So in a challenging year, the growth could come down to 12 to 13%. So I think about 11 to 13% is what we'll be aiming for this current financial year, because as you know, first quarter has been extremely challenging. So what happens with us is almost 60% of our products, 55 to 60% of our products are dependent on summer. So when you start with a very, very, adverse weather, it is very difficult for these categories to then perform, till Q4. So Q4 will determine now, how the growth will shape out. But typically we have seen that good years, if we have a good year, we'll grow at 17% and a challenging year at, 11 to 12%. So that's what this year looks like.
And sir, on the margins part?
Margins, I think we should be between 8.5% to 9.5% in this financial year. So let's see how it goes. Yeah.
And sir, my next question is with respect to the lighting segment. You did like earlier callers also suggested that there has been value degrowth. So I just wanted to understand how much value creation do you think this segment will do in terms of your entire business?
So I think when we did some research on the industry, we found that players like Signify, which is the largest player, with the trade brand Philips, Havells, Crompton, and Surya Roshni, all these four players are making healthy EBIT margins in the business. Now the question is on the value growth. We found that there are sub-segments which are growing. For example, downlighters and premium architectural lightings for house, for residential is growing, whereas the growth in lamps, etc., may be slightly plateaued. So there are sub-segments which are growing. It's not that like the entire industry is degrowing. And the third thing is we are present in categories like solar rooftop, where there is a value degrowth of 20-25% every year for the last 3 years. So it's not something that cannot be managed. It is something like Ram said. Every category has its own challenges. We don't foresee any growth challenges in the first 7-8 years, but once we become large, yes, we'll have to see. But I don't think that this category will remain like this forever. I think there are some tailwinds, especially on people migrating from tubes and lamps to more expensive luminaries. as the houses become more premium and as people start to spend more on interiors, this is something that is ongoing. So I think within this particular, lighting as a very large category, I think it's close to 1 lakh crores or something like that. If you look at the entire lighting in the country, including institutional and all that. So there are sub-segments within the entire lighting gamut that is growing. So yes, there are the lamps, the prices of lamps, the LED lamps are coming down primarily due to efficiency in design of the PCB boards and all that. But I think I don't think it will keep going down every year. I think a lot of the value decline is we probably close to the bottom as far as that is concerned. But we are more interested to sell a bouquet of products, not just lamps, which will make sure that we make money.
And my final question is with respect to the Indian factories for in-house manufacturing coming. So what is the current percentage of in-house manufacturing, and when will the new factories be coming to online?
So currently we are at 65%. We have one factory which is, one more plant for fans which is undergoing development. We expect that to be operational in 18 months' time. That will make table, pedestal, wall fans and some and ceiling fans as well. It will have all both TPW as well as ceiling fan. And yes, we have also setting up one more, that is more of an expansion of the existing battery unit. That I think will take about 24 months' time.
Okay. Thank you, sir.
Thank you, sir. The next question is from the line of Sonali Salgaonkar from Jefferies, India. Please go ahead.
So thank you for the opportunity. Sir, I again have a question on fans. Sir, correct me if I'm wrong, but is fans as seasonal a product or it is all the year round product? So I was just trying to understand it better. Why would an unseasonal rains or a disrupted summer lead to such a big decline in the sales and also a negative EBIT?
Okay, so I think in fans we have three categories: ceiling fans, TPW, and exhaust. The ceiling fan business is pretty much throughout the year kind of sales, but there will be maybe like a 10-20% variation between in season and off season. But the TPW business, which is especially the pedestal fans, it is an extremely pedestal fan is the largest part of the TPW. It is an extremely seasonal business because what happens, especially in South India, where especially markets like Andhra, Telangana, Tamil Nadu, even Kerala, it gets so hot that the ceiling fan is not able to really cool because it's really, really hot. So people put a second fan in the bedroom, which can force air from the side through the windows, which is cooler than the roof, which is already hot. So a lot of the pedestal fans, at least in South India and East India, goes for this reason, and they are extremely seasonal. So I hope this is clear. So if you look at the pan India sales, 70% is ceiling and 30% is TPW. Whereas if you look at South India for us, this drops down to almost 60-40. So in South India, the share of TPW sales is high, and V-Guard traditionally has been more stronger in TPW. Of course, recently we are also getting good traction in ceiling. So please understand that you will find that players with South skew will have this kind of a challenge. And secondly, there is one more category which is air coolers. So air cooler is also now large. It's about 140 odd crores. So a large decline in air coolers also brings down the consumer durable sales in first quarter. And air cooler is also a high gross margin category for us.
Just one more point I want to add, right? See, this year, last year, the summer was exceptionally strong. And this year, the rains have been exceptionally heavy. And I was just looking at some long period average data. The initial months that I saw, long period averages, nationally is, almost in double digit more. Yeah. And in fact, in the southern states, it's more than 30% up. Yeah. And, we are a company, besides what Mithun talked about, we are a company which is over-indexed in terms of sales in South and East, right, which have received very, very heavy rains. Yeah. So the pressure is further getting amplified in our numbers. Yeah. But as Mithun has already said, ceiling fan sales are flat for us, and the drop is in this particular category because southern market has seen very, very heavy rain.
Understood. So would you ascribe that majority of, or rather the main reason for the drop in your EBIT margin is because of loss of operating leverage or the general volumes, or is there any further reason to that?
I think it's majorly operating leverage. There would be some A&P expenditure on fan and air cooler that would have happened, but I think it's mostly operating leverage.
So your A&P spends as per your presentation are almost flattish year on year. So your overall is 3%.
No, I think, Sonali, it may not be spent on the same categories, right? So there could be changes within the categories. Yeah.
Understood. Got it. So, and just one last question from my side about the merger of Sunflame. So you did mention, certain points on that, but exactly what is the difference post-merger versus being 100% subsidiary wherein we are expecting a faster pace of synergies right now?
Yeah, Ram, you want to take this?
Yeah. Sonali, I explained this earlier, right? So let me again explain to you the same, clarify the same observation. See, for example, earlier Sunflame and V-Guard used to operate as separate entities. Yeah, the operational bandwidth inside the Sunflame was very, very narrow. So it was very difficult for us to replicate our understanding and know-how of how to run some processes, systems more efficiently than the way that it is running in Sunflame. Yeah. So that was the reason, initially, we wanted to keep these two separate so that, we are able to preserve the agility. We are a much larger company, work through multiple functions, right? And it would have been very difficult to integrate Sunflame at that stage. Yeah? But, after about 18 to 24 months, the knowledge is in place. Yeah? And, V-Guard internal stakeholders have understanding and exposure to Sunflame. And we have, as part of our integration project, defined, governance framework. We are able to move fast. Now, what difference will it make? I think, as I explained to you, giving the example of service earlier, yeah, in about it's about 70 days now since this has, the systems are coming together. They have come together progressively, and now we have completed the service integration. We expect in 3 months, right, to reach a similar level of customer service turnaround time. Yeah. Same is the thing with quality, right? The kind of systems that we have in managing quality, and the kind of process we have for qualifying vendors, right? All of this is very different, right? And so this all activities and capabilities will flow in. Yeah. We have, maybe 1,500 odd feet on street. We have 1 lakh plus customers. Many of them are in kitchen. Yeah. Now, it's a lot more easier for us, right, to land Sunflame offering into many of our customers and channels if it is managed through the same sales system, right? So these are the kind of advantages that we will get, right? So I think it's fundamentally going to make Sunflame stronger in its ability to realize outcomes, positive outcomes, right? Be it on service, be it on quality, be it on NPD, or be it on sales. Yeah.
Understood. Thank you, sir.
Thank you, ma'am. The next question is from the line of Shiv Kumar Prajapati from Ambit Investment Advisors. Please go ahead.
Yes, hi. Thanks for taking my question. My first question is regarding the competition intensity versus the rising private label players, say Amazon Basics. and what differentiates V-Guard's products in price-sensitive markets?
So I think the hyper competition today is among various brands. I don't think private label is such a big, such a big worry, at least in India. What we've seen is even in globally, private label usually works in categories which are, can't be differentiated, like, chips or, flour or, food products and stuff like that. Or something like a, generic item like, maybe lamp and, those kind of things, bulbs or something like that. But as soon as there is design involved, as soon as there is features involved, private labels usually don't have a chance. Because they're not having that kind of sophisticated capability to make products. So, for example, if you ask me, V-Guard has about 4,000 SKUs today. I don't know any retailer who has the wherewithal to, even manage, an additional 500 SKUs. So that is the kind of variety that brands offer vis-a-vis a private label. So we have seen that the larger chains, they have time and again try to do this, but it has not really, made any much dent, as you would have seen, right? I mean, there was a time when Big Bazaar bought out a lot of private labels. Reliance keep trying to do it. So it happens, but I don't think in our kind of categories it has really made much of a dent as yet. So the hyper competition is between existing players, getting into adjacent categories. It is also certain new brands, that are coming up, disrupting the existing categories, maybe using new lines of sales like D2C or e-commerce and stuff like that. So I wouldn't say private label, but definitely competitive intensity is up. It's primarily also because many companies are not growing and they are thinking that, the grass is greener on the other side and entering new categories. So that's the thing. I think we have also seen a lot of exits. So last 1 or 2 years, we've seen many companies defocusing or, removing themselves from the marketplace. So I think it's a natural process of, cleansing. I think whenever we have something like a slowdown and stuff like that, or, COVID also was a big shock. Whenever we have these kind of shocks, people tend to exit and, go back to their core because they have to protect their core, business.
Understood, sir. And sir, would you please be able to help me with 2 data points? Number one is now more than 50% of our revenue is from non-South market. So how many states will be contributing around 500 crores plus of top line for the full year? And going forward, what do you see, like which region or state would be able to touch this mark?
So I think we don't like to give out these numbers, but we have to understand that we also are in a country where you have something like a Maharashtra, which is like almost 10-15% of India's GDP, and then you also have small states. So we have big states and small states, and we have states which are geographically large as well. Like UP is a very large state; it's a large contributor to the GDP. But it is also very large. So we require more than, multiple branches. In fact, we have 3 branches in UP alone. Whereas in a state like Kerala, we are able to manage with 1. So I don't think it's right. I think we are slowly getting indexed to the, how the national market is indexed. I think earlier we had a very, very high South skew. And now, it is dropped below 50%. I think East has done well for us, and the other markets are also responding. So I think with the passage of time, we will hit that 65% of sales from the non-South markets. We are quite confident of that trajectory.
Got it, sir. And sir, is there any way or metric that you guys track for productivity of active dealer in South versus non-South regions, something like average revenue per dealer?
See, again, it's not very easy. We are not dealing with a homogeneous crowd. For example, we will have a wire dealer who will be doing 1 crore a month, whereas it will be very hard to find a guy who's selling switches for about 1 crore. So it's not it's not very easy to do that. Ram, you want to talk a bit about our sales?
Yeah. I think Mithun saying is correct, right? I think it's very difficult to have a thumb rule. But there are two issues with that, and at least as far as V-Guard is concerned. Our GTM is category-based rather than company-based. So we might have many times partners who are doing switchgear, for example, right? And they may or may not be doing other product categories of V-Guard. So some of those kind of challenges we have. Yeah? So I think that that may not be the right metric to look at as far as V-Guard is concerned, right? Also, again, as Mithun talked about, there are large states and, there are smaller states. Yeah. There are states by town class. I mean, there are cities by town class. And also, our entry into different states, or even in different geographies is at different stages. So, even as we speak, there are new markets, we are entering, right? Because we still have a lot of room to cover in non-South. Yeah. So I think it's a bit hard to measure on. So we don't try to measure on that attribute. So we don't have a perspective like that for this reason.
So I think how we like to do is that more than average revenue per dealer, we look at maybe average revenue per sales executive and those kind of metrics. That makes more sense. And in that sense, we find that eastern markets are quite close to the maturity as similar to our south market, and the other two zones are slightly behind in that sense. Other than that, it's very difficult. I mean, it's going to be very, very difficult to have a single view, to see whether. So what we look at is counter shares. For example, if a retailer is selling 100 units and it's split between 3 or 4 brands, there we look at how is our ability to gain more share. This is one part. Second is on influencers. So, for example, electrician, plumbers, other kind of influencers. We also try to see how many of them we are able to cover in each zone. And again, it's very difficult because we don't have the market data. We are not sure that if someone asks you, how many electricians and plumbers are there in India, you will get 5 different answers. So this is the kind of issue we are having. But if you look at the maturity wise, we would say that eastern markets, we are almost there in terms of the maturity, in terms of the average throughput per employee and those kind of metrics. The other two markets are slightly behind.
That's helpful, sir. Thank you so much and best of luck.
Thank you, sir. The next question is from the line of Divya Asiwal from Equirus Securities. Please go ahead. Divya?
Hello.
Yeah.
Am I audible?
Yes.
Yeah. Sir, Manoj Gori here from Equirus. I have one question. See, if we look at the electronic segment, where we have reported 5% growth. So my question here is, if you look at probably your commentary also sounded like South and East were very much impacted because of the poor season this year. So, and we have a lot of exposure to stabilizers linked to AC. Plus, this year the power shortages or power cuts were relatively lower. So, in fact, that would have impacted our UPS and batteries business as well. Can you throw some light probably the quality of this 5% growth, given the current environment? That's it, sir.
No, I think, stabilizer is, sale is directly linked to weather. And the other one is linked to the occurrence of power cuts. So they may not, yes, you're right, ideally should go in hand, but I can tell you that we have had severe power outages in the southern part of the country because of very, very strong winds and rains and stuff like that. So it may not be right to correlate, but we are seeing a healthy demand for inverters and batteries. And we are also seeing very good demand for solar stuff. So that is kind of offset. And we also have to understand that air conditioner stabilizer is about 50% of the total sale of stabilizer, or 50 or 55%.
Correct.
It is not 100%. So
yeah.
So the decline of whatever happens in that stabilizer to overall stabilizer may not, it'll be half of that. So that is also one reason. It's not like 100% what we sell for air conditioning. Yeah.
Yes.
One more point. Actually, what has happened is, we have gone deeper into the value chain in inverter battery, right? So consequently, our competitiveness in that category has improved, right? So that is also aiding the business on top of what Mithun has talked about, right?
Right, sir. That's all from my end, sir. Thanks and wish you all the best.
Thank you, sir. The next question is from the line of Abhijit Mitra from Anxious Alpha Investment Management. Please go ahead.
Yeah, thanks for taking my question. I hope I'm audible.
Yes.
Yeah. So regarding this, sudden spate of announcements coming on capacity cuts on, your cells, modules. I mean, what do you think can be the supply chain impact for inverters and batteries, and how do you think this will sort of impact the unorganized sector in this space? Any thoughts on this?
So you're talking about the solar PV models, right?
Yes. Not only, I mean, all sorts of cells, even, for lithium carbonate, which goes into batteries, they are talking of, cuts and all.
So I think definitely, it is a supply and demand issue, so we'll wait and see. So for example, if suddenly US is going to ban or slap anti-dumping duty for Indian PV manufacturers or cell manufacturers, definitely that would mean lower prices in India. Because so far we were not able to, because India has huge anti-import duty against China. So the Indian players were protected and they were enjoying, better prices and stuff like that. So we'll wait and see. Regardless of that, there has been a decrease in prices year on year. So because there is obviously a glut, of supply, and also the technology is getting better. In terms of lithium, I think I'll ask Ram. Ram, you want to comment on this?
Yeah. I think, yes, what you're saying is correct. There is a lot of uncertainty around, this entire space. Naturally, I mean, right now, lithium is the primary, what I would say, alternate energy chemistry. Although we have investment in a company called Gigadyne, which does not have lithium in it, but they are still not at commercial stage. So I think, yes, I think, it is going to be a big challenge, for expanding energy storage. But we'll see. I think, this is more, this is, again, there has been a lot of uncertainty around some of these things, right? And I think what part of, what is happening is basically about negotiating better outcomes for each other, and what part is about protecting and guarding. I think we'll have to wait and see. Yeah. I would say right now it's uncertain, and we would be speculating, an outcome ahead of something, that is, firmly announced, right? So, but yes, I mean, that naturally will be challenged. I think on the battery part, definitely, it will be a significant challenge, right? Yeah.
And for inverters and batteries, I mean, what percentage of your, purchase would be imports from China as of now? I mean, are there any direct imports from China which you would be doing now?
Only the solar inverter is imported. So solar business is about 20% of the overall inverter business. Only that is imported. The rest of the products are all made in India. Only the small, that is up to 10 kV, solar inverters are imported. The rest of the products, in the large solar inverters and the regular, inverters are all made in India.
Okay, so you are importing the entire box. You're not importing, say, a PCB or an MPPT separately. You're sort of importing the entire.
Yeah. So there is no technology in India that is available for small inverters, that is up to 5 kV. Almost 99% is imported.
Understood. So the string inverters are all imported, essentially.
Yeah. Anyway, electronics, everything is anyway imported. So whether it's China, Taiwan, or Singapore, or South Korea, electronics are anyway imported, unless India starts making that.
Got it. Great. Thanks for this clarity. Thanks. Wish you all the best. That's all from my side.
Thank you, sir. The next question is from the line of Anshul JT from LKP Securities Limited. Please go ahead.
Hi, sir. Am I audible?
Yes, sir.
Yeah. So thank you for the opportunity. So most of my questions have been answered. Just one last bookkeeping question. Just going through your segmental reporting in electronics segment, there has been a decrease in the assets part. So has there been a significant reclassification in the assets or any major asset being divested?
1 minute. Yeah.
Yeah, sure, sir.
So I think it's
Actually,
working.
I guess it's just normal business variations.
It's working.
Okay. No major divestment, right?
No.
Okay. Thank you, sir. That's it.
Thank you, sir. As there are no further questions from the participants, I now hand the conference over to the management for closing comments.
Yeah. So I think we can close today's call. Thank you all for taking time to join our earnings call. I would like to thank Arshia and the team at Nirmal Bang for hosting this call. We look forward to interacting with all of you in the next quarter. Thank you.
Thank you, sir. On behalf of Nirmal Bang Institutional Equities Private Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.